Good morning. Today, Monday, July 7th, let's walk through what's going on in the global financial markets. The global financial markets are navigating a period of heightened uncertainty, shaped by shifting trade policies, diverging central bank actions, and evolving geopolitical tensions. Over the past day, markets have reflected this caution. U.S. equity futures declined as trading resumed after the Independence Day holiday. Asian markets opened subdued, and European equities showed mixed results, all under the shadow of looming U.S. tariff deadlines and ongoing trade disputes. A major theme is the continued weakening of the U.S. dollar, which has seen its worst first half of the year since 1973. This has sparked debate about America's long-term financial standing. Central banks are responding differently. The European Central Bank recently cut rates, while the Bank of Canada and Bank of Japan are holding steady, and the Reserve Bank of Australia is expected to cut rates soon. Options markets are showing increased hedging and bets on volatility, especially in major U.S. indices and select stocks. Money market funds are seeing record inflows, signaling investor caution. Meanwhile, corporate moves like Royal Gold's acquisitions and NVIDIA's surge to near a $4 trillion market cap highlight ongoing industry consolidation and the growing influence of artificial intelligence. U.S. markets reopened with futures down after the holiday, following a strong previous week. July is historically a good month for U.S. stocks, but this year's outlook is clouded by tariff uncertainty. Earnings growth for the S&P 500 is now expected at 8.5% for 2025, down from earlier forecasts due to tariffs, though some analysts believe earnings may be understated. Investor sentiment is shifting away from U.S. stocks toward international equities. In Asia, Indian markets opened lower, reflecting global uncertainty and U.S. tariff threats. Experts expect continued consolidation, but see opportunities for long-term investors in high-quality, large-cap stocks. In Europe, markets were mixed, with some sectors hit by tariff risks and others by regional challenges. Notably, Dow announced the shutdown of several European assets, reflecting structural issues. The main driver is uncertainty over U.S. tariffs, with President Trump threatening new tariffs on countries supporting the BRICS group. A critical deadline for trade agreements is July 9th, with tariffs set to start August 1st for non-compliant countries. Oil prices fell after OPEC Plus announced a larger-than-expected production increase. U.S. economic data remains strong, with job growth and low unemployment, but the dollar's decline and global diversification are notable trends. U.S. Treasury yields have risen slightly, and there's a growing preference for Euro government bonds over U.S. Treasuries due to better yields and stable outlooks. High-yield credit spreads are tight, suggesting limited reward for risk. In the UK, fiscal concerns have led to selling in government bonds and the pound as foreign ownership of UK debt rises. The US dollar has dropped over 10% this year, its worst performance in decades, despite a strong domestic economy. This is attributed to erratic policies, rising debt, and political divisions. The euro and other major currencies have gained against the dollar. Central bank decisions, economic data, and political statements are all influencing currency movements. There's been a surge in hedging and directional bets, especially in the S&P 500 ETF and select stocks like Peabody Energy, Invesco Solar, and Robinhood. In crypto, Bitcoin's volatility is at record lows despite high prices, suggesting potential for future sharp moves. Ethereum is also seeing strong institutional interest. The U.S. Federal Reserve is holding rates steady, but the dollar's decline is raising concerns about its independence and long-term strength. The European Central Bank cut rates and forecasts lower inflation and modest growth, but remains cautious due to trade uncertainty. The Bank of England is maintaining independence but faces fiscal credibility issues as foreign debt ownership rises. The Bank of Japan is holding rates steady but plans to reduce bond purchases, citing uncertainty from U.S. tariffs. The Bank of Canada is also holding rates, with the economy slowing and inflation easing, but trade uncertainty remains a major risk. The Reserve Bank of Australia is expected to cut rates, with the Australian dollar weakening in anticipation. The Swiss National Bank cut rates to zero, citing easing inflation and a weaker global outlook, and is focusing on financial stability and digital innovation. Royal Gold is expanding through major acquisitions, and NVIDIA is now the world's most valuable company, driven by demand for AI infrastructure. Dow is shutting down European assets due to regional challenges. Carnival is refinancing debt to improve flexibility. Money market funds have reached record assets, reflecting investor caution. Politically, U.S. tariff threats and new fiscal policies are adding to uncertainty. President Trump's new legislation is expected to increase the deficit, and his rhetoric is affecting both markets and the dollar. In the UK, fiscal concessions are raising concerns about debt sustainability. The BRICS summit in Brazil highlighted geopolitical tensions, especially criticism of Israel. Markets are highly interconnected, with U.S. trade policy uncertainty rippling through equities, bonds, and currencies worldwide. Central banks are diverging in their responses, creating opportunities and risks in currency and bond markets. Political developments in the U.S. and UK are directly impacting market sentiment and financial stability. The AI and technology sector remains a bright spot, attracting capital and driving index performance. Expect continued volatility in U.S. equities as the tariff deadline and earnings season approach. Treasury yields will be sensitive to trade news and auction results. The dollar is likely to remain under pressure, especially if tariffs go into effect. Options markets will remain active around earnings and macro events, and crypto could see a spike in volatility. Indian equities and U.S. large-cap technology are attractive for long-term investors. Diversification into international equities and euro government bonds is recommended. Tactical plays in high-yield credit and currency pairs like euro, dollar, and Australian dollar may offer short-term gains. Money market funds remain a safe haven. Bitcoin and Ethereum, despite low volatility now, could see significant moves and are worth considering for long-term accumulation. Global markets are at a crossroads, shaped by trade tensions, central bank divergence, and political uncertainty. The immediate focus is on the U.S. tariff deadline and earnings season, which will drive near-term volatility. While caution prevails, there are clear opportunities for those who can navigate the complexities, especially in select equities, bonds, and digital assets. Staying alert to political and policy developments will be crucial in the days and weeks ahead. Thanks for watching.